living under a rock. Last time I checked a few minutes ago, Dow futures down over 1,000 points. Oil, many of the experts are predicting that it's going to open up around $30 a barrel. A lot of you have had some fantastic questions on Twitter today about how that low price of oil affects the corporate bond market, the credit markets. There's just this huge daisy chain, and I'm sure I'll get a lot of those in the questions. If not, I'm going to do a video on it tomorrow. Very timely and just crucial that you guys understand that. So before I get into the video, let's do a little bit of cleanup here, or a little bit of, let's see, just reading my notes. Okay, so the email, for those of you on the email list, I want to let you know that we've been having a really hard time with the provider, and Sebastian is working on changing it. We couldn't send out the email yesterday. We've tried several times. So if you're on that email list, which I encourage everyone to do because you get extra content, I write personal emails. We try to send out every video. So there's a lot of benefit to you to join that email list. It's just at georgegammon.com, but we're working on it. We'll get it back up to speed. See the podcast. That's what I've got written down here. Yes. Guys, keep in mind that we rip the audio for the Q&As and we put them up on iTunes and all the podcast platforms, and it's under the Rebel Capitalist Show. So check that out and give us a review if you like it. That definitely helps the search engine algorithms. And then as far as Marin's newsletter, I don't know if you guys saw the interview that I did with him. We uploaded it on Saturday, but he was nice enough to do kind of an affiliate deal with us. So if you'd like to help the channel or support the channel, and if you're thinking about subscribing to his newsletter, and a lot of people have different opinions on Marin. I've been reading his newsletter, Catoosa Research, for the last few weeks. I think it's fantastic. It's really helped educate me and look at investing in a whole new way as far as that speculative side of my portfolio. So if you're interested in doing that, smoking deal, we're an affiliate. There's a link at georgegammon.com. If you go to suggested resources and then the newsletter, and if you go through our link, you get a $1,500 discount, and plus we're an affiliate, so it helps support the channel there. So that said, let's get right into the questions. If you guys want to do a question, make sure I get it. Sebastian is on the line right now. Actually, let me get my phone in front of me. Go ahead and do a super chat. Sebastian is telling me that our affiliate link for you guys who are interested in checking out Catoosa Research is just www.catoosaresearch.com/George. So pretty easy to remember. Okay, guys, for the super chats, go ahead and shoot those in. Sebastian will give those to me in real time. And then if you have a question for the live feed, make sure you start with question, all capital letters, so I can see that. Let's go ahead and dive right in because we've got a lot to talk about. Go to the questions. Question: does avocado toast make me Someone's been watching Arthur. That's funny. You've been watching Graham Stephan. I've got a ton of respect for those kids. Him and Meet Kevin and my buddy Marco with Whiteboard Finance. As far as Stephan and Kevin, I just don't know that they really get the macro picture. Unfortunately, I think they might have to learn the hard way, but that doesn't take away from how much respect I have for what they've done on YouTube. Okay. A question from RH. Mortgage rates, will they go lower? I think so, especially if you're following what Jeff Snyder has said, and that the treasuries, the 10-year, not only an investment tool, but now it's become a balance sheet tool for these banks, for these hedge funds, because that's that pristine collateral that he always talks about going into the repo market. For that reason, Jeff thinks that there's only going to be more and more and more demand for that collateral to using these dollar funding markets, and therefore he sees a 10-year going negative. 10 years directly tied to mortgage. Well, it's not tied at the hip, but it tends to follow, or mortgage rates tend to follow the 10-year. So if you believe that the 10-year is going down from here, I don't even know what it is today. I mean, it dropped down to like was it 0.6, 60 basis points? I mean, it's just getting insane out there. I mean, every single day I check my Twitter feed. I'm just like, what is going on? Even what I was saying on the channel from the start, as you guys know, last 5-6 months, I've been posting videos. I've been talking about recession, the corporate bond market. I've been talking about all these things, but it's like they're all coming to fruition at one time because of the cerveza sickness catalyst. It's just, I never thought it all happened at one time. That's for sure. 2E-Volt. Thank you for the super chat. Would you consider homes in Boise, Idaho cheap? I don't know what the RV ratio is up there. I'd have to look at that first and foremost. And just for those of you who don't know, that RV ratio is just how much money you're getting per month gross rent relative to your cost basis. You want a 1%, but I started suggesting that 6 months ago, and the prices, even in Kansas City, have gone up so much since then. I don't even know if you can get that in KC anymore. I went on Zillow the other night and I was shocked at what prices were in those areas where I have my rental properties. I mean, it's great if you already own property, but if you're looking to get a good RV ratio, a good investment, it's tough. And I'll be honest with all of you right now. Today, especially, I've been going through my finances and my portfolio, trying to figure things out. And I haven't made any decisions, but I'm considering selling a couple of my properties in the US just so I've got a lot of liquidity. If we have oil stocks or XYZ go down in the market, I want to make sure that I've got plenty of dry powder to take advantage of that. Remember, the first rule of my investment philosophy is buying things that are cheap and selling things that are expensive. So if I want to buy things that are cheap in the future, then I might need to sell a few things that are expensive right now. So not saying that I'm doing that. I'm just thinking about it. And I'm definitely not going to sell all my dollar assets or all my rental properties, but just thinking about raising some dollar-based liquidity. But I'll keep you guys posted. Tyler, thank you for the super chat. I'm getting ready to buy my second rental property in Jackson, Mississippi. Okay, great. Is it a good idea to wait to see how the sickness market plays out in the coming months? I would, Tyler. Well, let me take that back a step here. If you've got a perfect rental property in mind, great neighborhood, great numbers, you've got a 30-year fixed rate loan at a super low interest rate already locked in, then I'd probably pull the trigger. It's so crazy right now. I don't want to commit to anything, but I'm just telling you, kind of thinking out loud here. I would probably do it. If you're just looking in that market and you haven't found the perfect property yet, I would hold off. I'd hold off, probably give it at least a month to see how the cerveza sickness really plays out in the US. You look at all these countries like Italy and Iran, and we all know what happened in China. And then you juxtapose that to what's going on in the United States. And granted, they are starting to cancel a lot of these big events. They just canceled South by Southwest. I saw that the NBA owners got a memo saying, be prepared to play games in front of no fans. There's a lot of these things happening. But also, I see all these pictures of people going to NASCAR, and that's the last place you want to be with the cerveza sickness looming. So my point is that I think Americans are really going to get blindsided by this in the next 2 weeks. So that said, Tyler, I think you get it. If you got the perfect property, I'd probably pull the trigger. If not, I would wait. Stacy, thank you for the super chat. Advice on where to park dry powder if rates go to zero negative. Still recommend T-bills or gold or a safe at home. Yeah. Also, I DM'd you. Oh, yeah. Okay, Stacy. Yeah, by the way, Stacy, thanks for Peter's email. He hasn't emailed me back. I think he's probably doing a lot with CNBC and kind of the bigger channels. And obviously, I'm not quite at that level yet. So One of these days, we'll get Peter on, I'm sure. I'll probably have to get my subscribers over 100,000 or something like that. But one of these days, we'll get him on for sure. But I appreciate your effort. So, if I remember you DM'd me, Stacy, and I'm trying to think of your exact question. That's right. I think you know Peter. You might live where he does in Dorado. I'm not going to say the exact neighborhood. I actually know it well because, as you know, I've lived in Puerto Rico. But I'm assuming you might be his neighbor or something like that, and saw him at the local restaurant there, the golf course. And I know he's very bearish on treasuries, which totally makes sense. But I think there's a big difference between being bearish on treasuries and 3-month T-bills. Because treasuries, if you bought like a 10-year, then you would be committing to owning that, assuming you wanted to get your principal back in nominal terms, you would be committing to owning that for 10 years. If you want to sell it in 3 months, in a year, 2 years, then you're going to be subject to the price. Therefore, you'd be subject to interest rates going higher. That's why Peter doesn't like those. And I totally agree. But with a 3-month T-bill, you don't have that risk because you can just hold it the 3 months. And once, let's say you have $1,000 worth of T-bills, in 3 months, you know you're going to get that $1,000 back. Now, granted, that $1,000 might be worth less, depending on what happens with the supply shock that I'm sure we'll talk about here in a moment, meaning that consumer prices could really spike. I mean, triple, quadruple at your local Walmart or Target. And therefore, your purchasing power, if that's the majority of what you buy, would go down. But listen, though, if interest rates go negative, let me think this through because this is really a good question. I think what I would do is I would pay very close attention to the repo market. I would look at the repo fails. If I felt as though the Fed or whomever had better control over the collateral issues in the repo market and the liquidity issues, then I would be much more, I'm very bullish, as you guys know, on gold long term, but I would be a lot more bullish even short term, in which case I would consider moving away from 3-month T-bills for my dry powder into gold if the interest rates on those T-bills were negative. That's you guys can, hopefully you can see that I'm putting a lot of thought into this one. I guess it's a tough question, very tough question, just to give you a cut and dry answer. Those are the variables that I'd be thinking about, Stacy. But I think right now, I'd still do 3-month T-bills and just roll it over. If I sell one of my properties or a couple properties, that's definitely what I'll do. But I probably won't go into 3-month because I want to keep that powder even closer to I want to keep that powder ready to go, maybe even before 3 months. So I try to find as short a T-bill as possible and roll it over. I think that's the best advice that I can give you. But I want to make sure that you guys understand the difference between Peter being really bearish on treasuries at the long end of the yield curve and I don't know his opinion on this, but that's not the same as saying that you're bearish on 3-month T-bills. That's really the bottom line for the question. Nick, thank you for the super chat. At what point is the S&P 500 a buy? Sub 250? I don't know if I'd go that far, Nick. I would. And what did we get down to in the last crash? We got down to like oddly enough, we got down to like 666. It's kind of you could extrapolate a lot of conspiracies from that. But what I would do personally is I'd probably take that low point and I would adjust it for inflation and see where that takes us. And then I'd try to get a historic trend line, and I would cross reference that with the CAPE ratio to see how close it's getting to 10. And that is how personally I would look at a possible entry point. So just to reiterate here so everyone's clear, I would look at the low point from 2000, whatever it was, 8, 9, intraday too. I wouldn't go on like the whole month. I'd adjust it for inflation. Then I'd try to figure out a historic trend line. Then I'd layer on top of that the CAPE ratio, and I'd be looking for around under 15, preferably around 10. That would be awesome. And then that's kind of when I'd be starting to get really bullish. And to be clear, I'd be looking at dividend paying stocks for the investment part of my portfolio, and then other bets that I was making that were more speculative, where I'm just taking a flyer on the price going up. Patrick, thank you for the super chat. I just jumped in and I'm all in Royal Dutch Shell. Don't go all in on anything, guys. All right. My time frame is 5 years. Does it sound reasonable? At 100%, it sounds reasonable. Well, let me be clear. Buying the Royal Dutch Shell right now for a 5-year time horizon, I think sounds reasonable. I would have scaled in, but to be clear, if you're saying that you did that with 100% of your investable assets, no, I don't think that's a good idea. It's not a good idea at all. I mean, guys, let Sebastian know in the chat right now if at the end, and I'm happy to stay on an extra 10 minutes to do this, but at the end of the live stream tonight, I can go over my just broad strokes, my personal portfolio, and show you guys what's happened recently with my portfolio and how, because I'm diversified, that I haven't, that one thing goes up, they all kind of go up together, but you don't have a big crash. It all kind of evens out. So at a worst case, you're maintaining the majority of your purchasing power. And it goes back to having everything in buckets, and then also being politically diversified and diversifying your currency risk. I think that's the main thing, because I have so many assets denominated in pesos, and the peso right now is getting crushed because of gold. Or I'm sorry, because of oil dropping. But I've got dollar assets and I have dollar cash flow. I have peso cash flow. I have dollar cash flow. My expenses are in pesos. So if the peso gets crushed, yes, I do, on paper, I lose some of my wealth in the real estate assets that I have, assuming that they're not going to appreciate the next, who knows, 3 or 4 months when I sell them in dollar terms. But I'm making that up because my purchasing power increases so dramatically because of that cash flow that I have coming in dollars. So, and I know it gets a little complex. It almost requires a whiteboard video. But remember, guys, if you can, it's very wise to not only diversify your portfolio from having different asset classes, but also from a political standpoint, political jurisdiction, and a currency standpoint. And I'm a perfect example of that right now. Okay. David, thank you for the super chat. You rock. Appreciate it, David. I do my best to rock and roll. That is for sure. I don't know that I achieve it every day and on every question, but I do my best, buddy. Futures are open and down by 1,000. Yeah, I know. What's the best way to play volatility, or is it too late? I'm not sure I'd mess with vol unless I was really sophisticated. And plus, it's already, over 40? As far as, and I'm referring to the VIX. Personally, what I'm doing, David, is I'm just waiting to see how the precious metals play out and how it plays, how the stock, assuming we get a crash, we'll see if we get a crash, how that plays out with the repo fails. And assuming that the more repo fails we get, and that's the oversubscribed, by the way, that's how I'm using that as a proxy. Excuse me, the oversubscribed numbers on the New York Fed's website, I'm using as a proxy for repo fails because I go back and look at the repo fails and I can't really find a chart that gives me real-time data. It's always kind of like a month behind. If you guys know of a chart, by all means, let me know. But so that's what I'm kind of using to measure that. Although, and I said this on the video, but just in case you guys don't know, what the Fed does in repo, even what we see, is just a fraction of the market. The repo trades up to 2.2 trillion per day. So if the Fed's messing around with a measly 100 billion, although that's huge for their balance sheet, we should definitely take notice of that. But as far as on the grand scheme of things in the repo market in general, it's really not that much. So my point is that if you see those repo fails really, really spike and then come back down, that's the entry point right there. And that's where I'd really start looking at the miners for a speculation, like silver miners. And I would look to play volatility that way, personally, just because I'm not that sophisticated as far as a trader. And you guys, hopefully you guys know that from a macro, and I'm by no means an economist, but I know the macro side of things a lot better than I know the trading side. I really don't know that much about trading. So you guys just keep that in mind. I'm learning and I'm doing my best to get caught up and understand things. That's one of the reasons why I'm doing those educational courses with Patrick Ceresna from Macro Voices on options. So if you guys haven't seen those, make sure you're tuning in. We're doing one a week. It's a 4-week series on options, but I'll be doing a lot more of those in the future, whether it's options, technical analysis, fundamental analysis, because I want to learn that myself. And I figure if I can learn it while I'm making videos, and I can just take you guys along with me and we can all learn together. Tony, thank you very much. Bud Light facts. I think he's talking about the cerveza sickness. Dogs can't get it. Mosquitoes can't give it to you. I'm not going to repeat that. Okay. It can survive 9 days on metal or a paper bag. Yeah, we got to. And not only that, it's got at least a 14-day latency period where you don't see any of the effects. You don't feel bad. And that can be potentially up to 24 days, I've read, and some of the stuff that Eric Townsend has been putting out. If you guys aren't following Eric from Macro Voices on Twitter, make sure you do that because he is right on top of this. Eric and Jim Bianco are the two guys that I'm really following to get the Corona information. And then, of course, Dr. Chris Martenson. Funding Jim, thank you for the super chat. Better to buy versus rent in Medellin for a 3-year hold time. No, I mean, if you're buying in dollars right now, oh my goodness, you're going to get a smoking deal. That's a tough question to answer, though, to be honest with you, because I'd have to break your question down by, if you're asking me, if for me that would be the right play or for the average person. The reason I say that is because to get a good deal in Medellin, you've got to know what you're doing. You have to be a pro. So I can do that because I've been doing it here since 2015. For the average Joe American to come down here and think it's going to be like the MLS back in the United States, where you just go pick a property, kind of blindfolded, spin around and just point your finger on something, and that's your investment, you're going to get crushed. You're going to get your butt handed to you. You're going to way overpay. And as we all know, in real estate, you make money on the buy side. So if you're someone that really knows what you're doing, you know the area on a street by street basis, you know how to find the motivated sellers, then yeah, now's a great time, especially if you're buying or you're exchanging dollars. But if you're not that person, Medellin's going to be a tough a tough market for you unless you just get lucky, or you talk to Sebastian and Sebastian can give you the properties that we're looking at. Or you got to know somebody is my point. And I'm happy to disclose that information to any of you guys that want to email Sebastian if you're interested in any of the properties that I've considered in the past, or I've put offers in on and they just haven't accepted them for whatever reason. Anyway, you guys know Sebastian's email. It's georgegammon.contact@gmail.com. Okay, Patrick, thank you for the super chat. Why can't we have interest rates based on supply of savings and demand of loans? It is time to separate state power and economics. Well, why we can't do that is because the modern way that money is created, it doesn't even have anything to do with savings, unfortunately. It's too bad. But it's just the reality. It doesn't. Banks don't even really need deposits anymore to lend. They create deposits with the lending. Now, a lot of people say, yeah, see, I told you that fractional reserve banking, that doesn't exist. That's all nonsense. Not really, because although the way fractional reserve banking is taught is a little different, the way money's created, the balance sheet still ends up being the same. So what's different is there doesn't have to be a lot of savings. It gets really technical and very nuanced, and it's tough to explain without a whiteboard. But I've got a video coming out this week with Professor Steve Keen. So if you guys know who he is, if you don't, you should follow him on Twitter. But he's been on Real Vision, on Macro Voices all the time. He is just an incredible, incredible economist. Not an Austrian, but he's got some very interesting views, just super, super smart thinker. So I interview him and we really get into the nitty gritty of how money is created. So tune into that. You guys are going to get a great, great education that's really going to help you see things differently. And once you see things the way they are, it's like taking the red pill in the Matrix. It's going to totally open your eyes to how banks really work, how money's really created. And then you can start understanding quantitative easing and inflation and deflation. You can start understanding these things so much better. So definitely check that out. I lost my place here, guys. Bear with me. Oh, you know what, Patrick? Now that I don't want to go off on a tangent here, but guys, it's very important. Also, you got to read Milton Friedman's Interest Rate Fallacy. I don't want to, I'm getting behind on the super chats here. The bottom line is just because interest rates are low doesn't mean that money's loose. It can be the opposite in certain situations. And Friedman wrote about this, and Jeff Snyder is really a big fan of Friedman's work on this. And Jeff talks about it all the time on his blog. And I've read some of the stuff that Friedman put out on this. And to understand where we are right now, I think you really have to understand Friedman's interest rate fallacy. So I'd love to explain it right here. It's definitely a whiteboard video that I'll do in the future, but between now and then, try to Google it and read through that as well. Free Thinker, thank you for the super chat. How do I time buying real estate 30-year fixed rate against the coming asset crash, given unknown Fed reaction curve? It goes back to what I was telling the other gentleman, or the other, I think it was a gentleman. I apologize if it was a lady. Oh, there it is. Sorry, Free Thinker, I lost your question there. Okay, it goes back to what I was saying, that if you have the perfect deal right now, I would go ahead and pull the trigger, because we know that the first question we should ask about that mortgage is not if rates are going lower or higher, but is it cheap or is it expensive? And obviously, we all know that debt is super, super cheap right now. historically speaking. Does it get cheaper? Maybe, but that's not the question that we should be asking. So if you've got the perfect piece of real estate, I would consider it. If you don't have the perfect piece of real estate, I'd probably hold off. And keep in mind that real estate really lags because sellers always try to hold out for what they think are the comps. So even if we had a huge crash like we did in 2008, 9, or potentially bigger, real estate won't come crashing down immediately. You won't wake up next week and real estate prices have fallen by 50%. It doesn't work that way. It's not like the stock market. Even if we have this huge crash, real estate prices won't start coming down because sellers won't want to accept reality. Because think about if any of you have sold a house and say you get the appraisal or your agent tells you that you're going to get 500 grand for it. You've already spent that money mentally. And you know this is true from a psychological standpoint. Any of you that have done this. Wow, I'm getting 500 grand for my house. Wow, I'm getting 200 grand for my house. I'm getting $1 million. How am I going to spend that? What type of house am I going to buy next? Am I going to buy in this neighborhood? You already go out and start looking for new houses. Maybe you want to buy that new car with all this money that you've made from the house appreciating in nominal terms. You see, so people get emotionally attached to that number. What happens if the market crashes and the buyers go away? It takes months for them to come to the reality that, oh, shoot, I'm not going to get that 500 from my house. I'm only going to get 400, and I might not even get that. So that takes a while is my point. Steven, thank you for the super chat. Here's another one. Jeez. I'm about to buy a home, but scared. I live in South Texas, 210K house. That's actually, wow, that sounds pretty cheap on a price per square foot. On a half acre? Need help. I'm a truck driver, married wife, stay-at-home mom. Okay. Using a VA. Yeah, with a VA loan too. See, this is an example of a property that I mean, that's pretty darn cheap. I don't know if that's out in the middle of the boonies, Stephen, or not. But 210, that's not bad on a half acre. So this could be an example of your perfect property for your wife, for your kids, and especially if you're getting a VA loan on it. I know that has a lot of perks. Maybe you go ahead and pull the trigger. I would definitely lean toward pulling the trigger on this one. And the bottom line is, let's say housing prices crash by 50%. Well, okay, you're not going to sell the house. So yeah, it would have been nice to get it cheaper. But what if housing prices go up as a result of negative interest rates? Then you're going to be kicking yourself. And no one has a crystal ball. It's all just a matter of trying to weigh these probabilities. And that's, by the way, that's one reason why a lot of the times I stop and pause and try to think through these questions as much as I can, because I'm not just one of these people that's going to say, oh, don't buy. I'm not like Jim Cramer, where you guys just throw me a question. I say, oh, buy. Oh, sell. Oh, buy. That's idiots do that. What the smart, and I'm not saying that I'm smart by any means, but the smart people that the Stan Druckenmillers, the people on Real Vision, on Macro Voices, they don't just look at something and say, oh, buy, or sell. They think about all the probabilities, and they're trying to weigh all the probabilities in their head to find out, is this a 55% chance of happening, a 35% chance? Because there's no 100%, there's no zero. So it's got to be some shade of gray in the middle. And I think if I can get you guys to start thinking that way, instead of binary like most people do, I think it would be if my channel can do one thing and that's it, I think it'll be a huge success. So again, I want to make sure that I'm clear on your question, Stephen. If this is a perfect property, sounds like it is, I'd probably pull the trigger because of how cheap you're getting the debt and all the perks. If it's not the perfect property, I'd hold off. Funding Jim, thanks for the super chat. 3-year as an occupant, lease or Airbnb later. Oh, so I'm I think you're coming down here funding Jim, in which case I look forward to meeting you face to face. So for you, for you, I would just use Sebastian. And if you're going to be down here 3 years, I'm obviously not going to charge you for that or anything, but I just talk to Sebastian when you're down here and just say, hey, help me understand this a little bit better. And if we grab coffee, I'm happy to show you how I do it in the areas that you want to look for. And I can give you the price per square meter. That's what we do down here. It's price per square meter instead of per square foot. And I can say, listen, don't pay over this. Just don't. And if you can get a deal under this price point, then consider it. If you can't, rent, lease. So I would, if you're coming down here right off the bat, I would Airbnb it, look around for a month, and then try to make some good decisions once you've absorbed everything. Ira, thank you for the super chat. With impending global crash, what do you think silver is going to do, since it has big ties to gold, but also big ties to industry demand? Excuse me, guys. I like silver. It goes back to what I was saying with the repo fails, and that's how I would look at it. I do understand your question, how it's got more industry demand, so you would think that the price would go down further than gold. But in times of fear, generally gold goes up, but in the end, silver goes up further because more people in the world have access to silver, because the price per ounce is a lot lower. And that's per my, and I'm not just making that up off the top of my head, that's per my conversation with Rick Rule. If you guys haven't seen that, I would strongly suggest watching that interview that I did with Rick, the full hour-long piece. That'll give you, he goes into that in extensive detail. But I would hold off right now in silver until the repo signals that I was giving, until the repo signals, can't even talk. I would hold off until the repo signals were giving me more of a green light. And if Ira, I'm assuming that you watched my video Friday or whenever, Friday, when I went over the correlation between the repo market and the gold price. If you guys haven't done that, you don't know what the hell I'm talking about. I always assume you guys have watched every one of my videos, and that's an inaccurate assumption, obviously. So if you don't know what I'm talking about, watch that video, watch step number 3 specifically, and you'll get what I'm saying. And I've got a chart in there from Jeff Snyder that will really help you it'll really help you see the big picture there. Jan, thank you for the super chat. Do you think the bond ETFs will start collapsing once they start downgrading bonds like the mortgage-backed securities did in 2008? You're talking about the junk the junk bond market, the corporate bonds, and I think that bubble has probably popped, especially when you consider what I was reading today. I saw mixed data. I saw anywhere from 10 to 40% of the junk bond market is shale or oil related. If oil goes down to $30, oh my gosh, the shale, the whole complex is going to completely blow up. That sends junk debt, the interest rates, just through the roof. And I'm going to go into that in tomorrow's video. So stay tuned, not only the junk debt, but the investment grade as well. And the other big piece of the puzzle is how that oil price going down affects all of the dollar-denominated debt that's outside of the United States, not just sovereigns who in 2012-13 just loaded up on dollar debt because the DXY was down at 70-75, and now all of a sudden they're having to roll over that debt. This is what Brent Johnson always talks about in his dollar milkshake theory. So it's not just about the low price of oil blowing out the shale industry and that affecting the corporate bond market. Although that is a huge, huge, huge piece, it's also about how that oil makes it much, much harder for countries like Colombia to service all of this dollar denominated debt that they have. And in the FX market, that could make the dollar appreciate greatly. But then you've got the cross current of the Fed printing all this money. Last time I looked, the DXY was in a 95 handle. I think it was 95.9 or something like that. I haven't looked at it over the weekend. But that's telling you that although we're getting all of these dollar pressures outside of the United States, which is what Brent talks about, and guys like Raoul Paul and Jeff Snyder, it seems like just for the short term that the counterbalance to that, which is all this additional money that the Fed is most likely going to print, is overwhelming the dollar demand in the FX markets outside of the US. But it gets really tricky there. Let me go back to make sure I get off on these tangents, and I want to make sure I answer your question specifically. Yeah, okay, so I answered it. Yeah, it's that's a huge bubble. And as you guys know from watching my videos, I've been talking about the corporate bond market being the big piece of the bubble blowing up and the next recession. I've been talking about that for 4 months, 5 months. And I don't want to take too much credit for that because, of course, I'm getting it from the guys at Real Vision and Macro Voices. But a lot of people that are a lot smarter than I am have been talking about that for a long, long time. Okay, mortgage-backed securities did. Yes. Okay, XRP Gal, thank you for the super chat. Thank you for helping understand finance like no one else has. You're very welcome. Thank you for the super chat, and I appreciate the kind words. And like always, guys, I really sincerely appreciate, we all do, myself, Sebastian, Thomas, Danny, everyone who's part of the team, really appreciate you guys taking the time out of your schedule to watch and comment and to join us on these live streams. It really means a lot. And obviously, we're enjoying this just as much as you guys are. Baxter, thank you for the super chat. Hey, George, your Rebel Capitalist show really on fire lately. Keep it up. How would you recommend playing the Corona? I almost said it. I almost said it. I was trying not to say it on this video. I want to keep this one monetized. How would you recommend playing the Cerveza sickness in terms of investing? I'd try to keep some powder dry, and I would wait to bargain hunt if Exxon, as an example, or Shell or Chevron or some of these companies just get pummeled. And if the price of oil goes down to 26 or 25 or whatever it goes down to, those share prices are just going to get crushed, and they're going to be paying a huge, huge dividend. And even if your argument is, yeah, George, I don't know if I like that because I'm more into green energy and I think oil is on a downward trajectory, that's fine. I'm not going to debate that right now. But what you have to understand, if that's your position, is that if you believe the stock market is going to crash and the credit markets are going to seize up, that means that all the money that would be invested into a lot of these green energy companies that aren't turning a profit isn't going to be there. So all of this growth that we've had in that industry over the past 10 or 12 years of ZERP, it's even if we have ZERP, it's not going to be there if the credit markets are frozen. And so that is very, very bullish for oil. And again, I'm not saying if that's good or bad. I'm just saying it is what it is. So right now, that's what I'm doing personally, is I'm just starting that watch list of stocks that I'd like to buy at half the price, half of today's price, not 2 weeks ago price. And that's what I'm doing, and that's what I'd suggest everyone doing as well. But I want to be clear. I'm not saying buy right now. A lot of people confused that on Twitter. If you look at the research, the market cap to GDP, During the early 80s, it was about 30%. We went all the way to 150. And even though we've had this big crash in the market, it's still at 150. So the market is still wildly overpriced, even though we've had, call it a 10, 12% down move, a volatile down move in the last couple weeks. It's not cheap yet by any stretch. Baxter, thank you for the super chat. Hey, George. Oh, no, I'm sorry. That's the one I just did. All right. William, thank you for the super chat. So you highly recommend Katusa Info. It is a bit expensive. Not with the price that he gave us. Everyone at his office is named Marin. So, so the Marin, not Katusa, but the other Marin was really nice enough to give us a huge discount, and it really drops the price by $1,500. And I've been reading the newsletter and the research over the past few weeks, as most of you know, and I think it's fantastic. I really do. My position is, if you've been thinking about buying his newsletter in the past, but you've just never pulled the trigger, I would definitely do it now. If you're one of those people that says, I don't know, I don't really get into that type of information or research, then it's probably not right for you. But if you're someone that thinks that it is right for them, I don't think you're ever going to get a better deal as far as the price point. And I've been really enjoying it myself, or else I wouldn't recommend it. Thank you. Oh, I'm sorry. Steven, thank you for the super chat. Says, thank you. Keep doing you. Okay. And have faith. Yes, I appreciate that, Steven. And I appreciate the super chat. Same shirt, different day. Thank you for the super chat. Hey, George, can you spare a dime? Well, I don't have too many dimes right now. Same shirt, different day, because I'm doing everything in pesos. I got a couple pesos, but no dimes. Abby, thank you for the super chat. Just joined. Keep hearing that no serious crisis is coming. Who are you listening to, Abby? You must be listening to your friend and family member, Fred, or Trump's Twitter feed, one of those two. Why is there such a divergence in opinion? Oh, yeah, that's a great question. My opinion, S&P 1700 before December. Yeah, I think none of us know, obviously, because we don't know what the Fed's going to do and how much money they're going to print, how much quantitative easing. We don't know how the market's going to react to that. But I don't think that's a crazy number by any stretch. That's 1700 on the S&P. Why there's such a divergence? Because just normal people, they don't care about this stuff. We can all point our finger at them and say that they should be more educated on macro and what constitutes money and currency, and it's so important to everyday life. It is for us, but the reality is we're only a very small percentage of the American population. Most people don't give a damn. Most people don't know what the Fed is. Most people, the only thing they care about is their Netflix, making sure that the sports are games are on, making sure their kids are getting to school on time, going to soccer practice, meeting up with your girlfriends or guy friends on the weekend, having a few beers, nice glass of wine, nice dinner. That's their mindset. That's all they care about. And what's crazy about the cerveza sickness is it has taken a stranglehold on all of these countries outside of the United States, and the Americans are just completely ignoring it. Like it's not, like it's never ever going to affect them. And I totally get it, because it's all this recency bias, and we haven't had a crisis, especially not like one of these health crises in the United States for so long, that people just think it can never happen to us. Oh, it happens to the Chinese all the time. They get those swine flus and the SARS, or, oh, it happens to these people. It happens to those third world countries. But it never happened here in the United States. Let me just roll down to the the basketball game with my buddy who's been coughing for the last week and grab some beers. I hope it doesn't happen, but especially since the United States, they haven't been doing any testing, and they've been treating this like it doesn't exist. So that's the problem, because if you're treating it like it doesn't exist, it's going to spread, and by the time you understand that, oh, you guys know what I'm trying to say. Oh shoot, this is a big problem. Now you can't control it. It's already gone. It's already spread, and now you're just at the mercy of what it's going to do to your population and your economy. That's the real danger that I see here. But going back to your question, it's because most people just don't care about this stuff because they've just got their normal lives to live. Greg, thank you for the super chat. Up on the TVIX, which I assume, yeah, it's a way to play volatility. 207% in 2 months' time. Yeah, I'm actually a little long the VIX too myself. Not through that method, but through a different way. What is your call regarding upside downside? I think you got a lot of upside. I think you got a lot of downside. If I was you with a 207% gain, I'd probably sell it, take some, and this isn't investing advice. As you guys know, like I said, I'm no trader. I'm trying to get there. I'm learning along with you guys, but I'm much more of a macro guy. I understand the from an economic standpoint, I understand the repo markets. I understand the complex systems of how these things work. But how to trade that idea and make money, I hate to give you any definitive advice other than what I would do or the suggestions that I would give my own family members. And when I do increase my skills, by all means, I'll let you guys know that, hey, yes, now I'm very comfortable giving you advice on whether or not to sell the VIX. And I'm sure I'll get there soon, but just not there yet. So again, what I would personally do is I'd probably sell it with that much of a gain, and I'd keep some dry powder for other things that are getting super, super cheap, like maybe the oil companies here in a month or so, maybe a couple weeks or so, or the silver miners, something like that. Or Bitcoin. I mean, Bitcoin's down a lot too, isn't it? I'm sure I got a lot of Bitcoin people on the chat. I think it's maybe in the 8,500, which would, I don't really know much about Bitcoin at all, but it seems as though it's doing maybe that same thing that gold was doing. And I went over my video on Friday where people need the liquidity. And so they're selling whatever they have that's liquid. That could be gold, that could be Bitcoin, that could be silver. Now, granted, gold is going up, but you've got the two counterbalances there. Remember, we don't want to think in binary terms or just in one direction. We want to think of the cross currents. And now you've got the cross currents of liquidity, fear, and collateral. These are the cross currents you're dealing with. So we could have a situation where the fear is overriding the liquidity in the gold market, but the liquidity is overriding the fear in the Bitcoin market. See? So that's where you have to start. But don't want to go off on a tangent there. I just thought that was interesting, and that may be a reason why Bitcoin might be going down a bit. In which case, you've got to pay attention to the repo market. Free Thinker, thank you for the super chat. Consequences of Fed buying stocks. Yeah. It's just pathetic that we've come to that, in my opinion. Yeah, I saw, who was it, Bullard, that came out and said something like that the Fed should expand their horizons as far as what assets they'd consider purchasing, meaning they're thinking about buying stocks. It's the unintended consequences are limitless, just limitless. I mean, at some point, that the release valve has to be the dollar, even if it's 3 years, 5 years, might not be short term. Those chickens are just going to have to come and think of, oh man, just think of all of the malinvestment. Think of the moral hazard with this, guys. This really frustrates me. Not you guys, but that the Fed is even considering this. What are corporations going to do? These corporations have bought they've borrowed money from the pension funds because the Fed has dropped rates. That they've taken that money that they borrowed from the pension funds. They go out and they buy their own shares back. They're the only net buyer in the stock market since 2010. Not the only, but they're the majority net buyer in the stock market since 2010. Think about what you're doing here at the Fed, guys. If that created moral hazard, which obviously it did, how much moral hazard are you going to create by not only there being a Fed put in the sense of them lowering interest rates or doing quantitative easing, but now there's an explicit Fed put in the sense that they're just going right straight into the market and buying it. What are corporations going to, I mean, you don't even have to get into the morality of it. I mean, what CEO isn't going to just leverage everything that their business has to buy their own shares back if they know that the Fed isn't going to let the price go down? I mean, how do you not think of this stuff? It just drives me crazy. But I hate to be vague, free thinker, but that's the best answer that I can give you. What are the consequences of the Fed buying stocks? They're just limitless. There are too many to list. I think my best answer to that would be that long term, there is no positive consequences in that. There are only negative consequences. Long term. Short term, yes, you could get a little sugar rush. You could kick the can down the road even further. But long term, it's just going to make matters worse. Feral Android, thank you for the super chat. Colombia has the cerveza sickness. Yes, stay safe. Yes, I appreciate it. Thanks for all the great info. I'm glad you brought that up because, as you guys know, I employ quite a few people here, not just with the YouTube channel, but with my real estate projects. I employ a lot more people with the real estate projects than I do just with the YouTube channel. But I need to make a decision, especially if this starts to get worse in Colombia, which I would imagine that it's going to. I might have to take a week off of the videos, or because I don't want to put my staff at risk or any unnecessary risk. And you guys might not know this, but where I live in Medellin, or where I spend time, it's right in the tourist zone. It's in a place called Poblado and Parquearis and Provenza, and it's just nothing but tourists funneling in here every single day. So if we're going to get it, this is going to be a spot that's going to be a hot zone for it for sure. So do I want to subject my employees to that? Probably not. I don't want to have any delay in the videos, but people's health is far more important than these videos. So if I decide to take a week off, maybe next week, obviously I'll let everyone know on the live stream. And then what I'll do from wherever I go, if I stay here, whatever, I'll just maybe on Monday, Wednesday, Fridays, maybe I'll just do quick live streams just to answer questions or do the daily news just in lieu of the whiteboard videos until this settles down and I feel more comfortable having my staff come into this real touristy area. But I'll keep you posted on that. I'm glad. And I was going to write that down on my list to go over at the beginning, kind of the house cleaning stuff, and I totally spaced it. So thank you for bringing that up. Wally, thank you for the super chat. Will the Fed's emergency rate cut become a straw that breaks the camel's back in the wait a minute here. Will the Fed's emergency rate cut become a straw that breaks the camel's back on the economy considering Friedman's interest rate fallacy? Well, I don't know if the two of those are connected that way. I don't think that the no, the Fed's emergency rate cut, I think, exacerbated the straw that broke the camel's back, because basically what the Fed was saying is, yeah, you need to panic. And if you think about when the Fed has done that in the past, meaning when they've dropped 50 basis points or more, which by the way is very rare. Generally, it's in 25 basis point increments. And for them not to do that, or for them to come out and drop those rates when they're not in a meeting, excuse me, that's super rare. And the only time they've done that in the past, with the exception of, from what I saw, with the exception of going into Y2K. I think they did it for Y2K and it didn't really affect the market, but they did it for 2008, and the market really has a history of going down substantially after they do that. So that is not a good omen. But I don't know if those two things are directly correlated. I don't know if the rate cut was the straw. I think it just exacerbated the straw. But it's great to see that you're on top of Friedman's interest rate fallacy. I suggest everyone reading that and the work that Friedman did on the euro dollar. He wrote a paper for the Fed back in 1971 that Jeff Snyder turned me on to. Fantastic, very easy read too. Definitely, everyone needs to Google that, read that as well. Toby, thank you for the super chat. Silver or small increments of gold, doesn't have a ton of cash to throw at it. I'd probably go silver. Maybe a little bit of both. But yeah, probably silver. It's tough because, as you guys know, I don't really look at gold and silver the same way. I look at gold more as an insurance policy, silver more as a speculation. And I don't want anybody to go overweight speculation, especially right now. But if you can't really buy an ounce of gold, then I would prefer to have silver as an insurance policy above paper or fiat. So hopefully that makes sense, Toby. Harry, thank you for the super chat. Gave me a super sticker. Cool. I'm not sure. Oh yeah, I think I saw that. One these stickers are like, they animated or something. I thought I saw that on the chat stream. But very cool. I sincerely appreciate that, Harry. Thank you. Jonathan, thoughts on the miners, GDX, etc. I think if you're thinking about getting into the miners, well, number one, if you're thinking about getting in the miners or into gold, and you've thought about getting some research on it, I'd consider Marin's deal, because Marin has a great track record over the last year compared to gold and the GDX. Like the GDX was like 38%, Marin was up like 90%. Really crazy. That I'd look at that, but I also look at the educational series that I'm doing with Patrick. And if you understand options, that can be a really neat way with the speculative side of your portfolio. Let me be very clear, to get into the miners. But I like the miners a lot. That's really the bottom line. And for me personally, with that speculative side, I'm just waiting to see how the repo market plays out. And then once I see that the fails are on the downtrend and under control, and I have no idea how that's going to happen, but once I see that, then I'm going to assume that the miners are probably bottomed out, and then I'm going to really start to get aggressive. But I would be dabbling right now just because they're so darn cheap relative to the price of gold. Keep in mind, historically, that has been a bearish indicator, though. historically, if the miners aren't keeping pace with gold, that means that gold probably will retrace a little bit. Seth, thank you for the super chat. Thanks for your content in bombastic style. What is bombastic style? What does that mean? Is that good? I'll assume that's a compliment. Thank you very much. The one thing I do know is I have been called worse, Seth. So thank you, my friend. What do you think about Basel 2 and 3 as a limit on euro dollars? Has anyone you've talked to mentioned this? Sure. Snyder talks about that all the time. And his point is that the Basel 2 and 3 really didn't do much to that because the banks started doing that prior to those rules even coming into play, as far as what they were doing with their balance sheet, keeping more liquid relative to their equity, whatever the nitty-gritty of the regulations are. Snyder doesn't think that played a really big part of it. It's kind of an afterthought that everyone can point to, because on the surface, if you don't really dig around a lot, it seems like, oh, well, obviously that's the problem. But the people that I've spoken to that really, really understand, although it could have been a factor, it's not the main thing. You know what? It's like the mortgage-backed securities in 2008. That was definitely a factor, but it wasn't the main problem. And I think it's the same thing with Basel 2 and 3, or the GSIB, or the liquidity coverage ratio. And has anyone talked about it? Snyder has talked about it a ton. So if you go to Alhambra Investment, I think their website is alhambrapartners.com, or just follow Jeff on Twitter and check out his blog. He's always posting stuff. And if you go through the search of his blog, you'll see a ton of articles on that. Tony, thank you for the super chat. Vitamin D equals immune plus bacterial system. I appreciate the intel, my friend. I will keep that in mind. Maybe we'll have Sebastian, maybe we'll have Kayla go buy some of that tomorrow. Kayla is the gal that does she's someone on staff. She goes to the grocery store for us. Harry, thank you for the super chat. First, most people don't care because they're broke. Yeah, maybe. Yeah, if you don't have investable assets, you could have a point there, Harry. Second, what publication do you recommend? Sorry, I missed it. I've been recommending Catoosa Research. If you're interested in the resources, if you're interested in like tech stocks and biotech, it's not for you. But if you're interested in the resources, I think it's great. He's a guy just like Rick Rule, Doug Casey, Ross Beatty. They're all kind of in the same group. And that's how I knew about it, because I've been following those guys since 2012. And I'm a big fan of what Marin's done. And I always watch his YouTube videos. And so when I talked to him and we went back and forth, and we were going to do the video anyway, so he talked to me about doing this and doing an affiliate deal. I said, yeah, absolutely. And they were nice enough to give the viewers a $1,500 discount. And so, but before I did that, I wanted to read it myself before I was like, oh yeah, I'd suggest doing it. And I've been reading it the last few weeks, and I think it's fantastic. I think it's really good, but it's not for everybody. So if you're someone that's really interested in the resource sector and you've been thinking about possibly getting into or buying a newsletter, I think you should definitely consider this Catoosa Research, and because you're never going to get it at a cheaper price. But as far as a publication, and I also always want to mention Real Vision and Macro Voices. For sure. FI, thank you for the super chat. I feel low interest rates has people buying bonds, stock, expecting capital appreciation. If they don't continue forever negative interest rates, I think there will be a massive correction all at once. I don't know if the low interest rates are having the effect on people buying stocks right now. I think the majority of the stock purchases are coming from people just that have been programmed into buy the dip. And one thing I always do to try to get a read on the normies, if you will, because us tinfoil hatters, we're not the normal people out there. We're just a little teeny weeny small fraction of the marketplace. If you look at the people who are commenting on like Dave Ramsey videos or Susie Orman or something like that, or even a lot of the YouTubers, some of the younger guys, some of the millennials, you'll see that it's just every single one of them in the comments is talking about, oh my gosh, this last week was fantastic. Now I can buy the dip. I'm going to be rich. I'm going to get rich because Tesla came down from 980 all the way down to 700. Oh, this is a gift. This is a Christmas gift come early. I think that's the majority of why we have these big swings on the upside that are counterbalancing the downside that we've had. I think at a certain point, those people realize, uh-oh, I was wrong. Uh-oh, this time it may be different. This time, the stock market might not go back up. It might just keep going down. Once you get that capitulation with the normies, then I think it's time to consider buying, because then all of your sellers are gone. And no matter how bad things can get, the market consists of buyers and sellers. And even if things can get 10 times worse, if all the sellers are gone, that's the time to buy. So my point is that's what I'd be looking for. Negative interest rates. I just don't see negative interest rates pushing stocks back up. It's the Fed government versus reality that I've been talking about in the videos and on Twitter. I think that reality is so huge right now, and everyone's seeing it in the news, and especially when this hits home for Americans, especially when this hits home for New York City, right where all these guys and gals are that are big market hedge funds, private equity funds. Once it hits home for them, I think that fear is going to completely override anything the Fed can do as far as trying to put in an implicit put. Now, the explicit put, maybe that's different, but that negative interest rates, that wouldn't be them just going right into the market and buying. Keith, thank you for the super chat. I bought 15K of GDX, URA, SLVP, definitely cheap. If they rise, when do I get out? Hospital already maxed out for flu every year. Yeah, exactly. Yeah. If we get more ICU patients, that's a great point, Keith. It isn't necessarily about the death rate. It's about the serious complication rate. That's what we need to get in our heads, because it can overwhelm the medical system. And then the death rate will artificially go up a lot higher than it otherwise would have if people just could have got the proper care. And again, we as Americans don't even think this through, because it seems so unrealistic for it to ever happen in the United States that our hospital system could be overwhelmed. But it very well could be in the next couple months. As far as when to get out, it goes back to what I always say, Keith. Is it cheap or is it expensive? Right now it's cheap. Hold it till you think it's expensive. That's the bottom line. And how do you do that? Just inflation adjusted charts. I'd look at gold. I'd look at silver. I'd look at uranium. And uranium's got a long way to go, by the way. I would just, you're in when they're cheap. If that's what you believe, I would look at the charts. I would say, okay, when are they expensive? Assuming they go up that high. And then when they're expensive, I'd sell them. And then I would try to look for what's cheap then and just keep doing that. Maintaining, of course, you've got a core position in gold for insurance. Want to make sure that I always say that. Jonathan, thank you for the super chat. Are there any specific businesses that you have your eye on besides oil company, which are on your watch list? Yeah, the cruise lines, they've got a lot of debt though. I looked into Carnival Cruise Lines. I talked about it on a video the other day. I looked into it a little bit further. I don't like their balance sheets as much as I like some of the oil balance sheets. So I'm leaning a little bit more toward the oil sector right now. But I would just look for things that have gotten crushed by what's going on in the world. Also, Jonathan, I'm glad you brought this up. Let's not forget, guys, that there's a lot of markets in general that have been smoked as a result of oil going down or what's going on with the cerveza sickness. Look at the Dubai market, got crushed. At least I saw a chart on Twitter. That's getting crushed. That's what were some of the others? A lot of these oil producing countries, their stock markets are really, really down. So that might be an interesting way to play oil if it gets down to $25 a barrel. If you're someone who wants to diversify your currency risk, your political risk, that could be a good way to do that. You maybe even be able to get some better deals, better yields. Definitely something worth looking into. Archie, thank you for the super chat. What is Marin's newsletter like? How do you plan to use his info in your own portfolio? What is Grant's newsletter like? Would you recommend either? Well, I've never read Grant's newsletter, but just from having the opportunity to talk to Grant, I can't imagine that it would be anything less than phenomenal. And I want to tell everyone too that a lot of people I saw in the comments said, wow, Grant seems like such a great guy. He's very humble, but he's so intelligent. That's the way he really is. I went back and forth with Grant a lot via email prior to our conversation. Then I talked to him a bit before we recorded and afterwards. He is just a fantastic guy, just a really cool dude, down to earth, just wicked smart. So I can't imagine that his newsletter wouldn't be fantastic as well. As far as Marin's, what's it like? The one thing I really like about Marin's is it's very educational. I wasn't expecting that. He has like kind of not tutorials, but a book in there that he suggests reading before you even do anything that just lays out resource investing in a way that's very, very easy to understand. I really like that. And I'm still in the education phase of it. So I haven't really considered taking any of his recommendations and purchasing. In the future, I might. But the way I look at it is just another source of information and education. And so once I feel as though I get educated, I want to continue my educational journey through reading his research. But then also, I want to look at what he says, but then think through it critically. I would never be one of these people that would just buy a newsletter and say, oh, that's what they recommended? Okay, go to my trading account, Interactive Brokers, done, buy. I would never, ever, ever do that, ever. I would look at their recommendations and I would say, okay, interesting. Now let me do my own research and see, that's just an idea. Let me try to refute the idea. Let me try to, what's the counter argument to that? And let me look at their balance sheet. Let me do these things. Let me utilize the education that I've received as a result of reading the newsletter, whether it's Marin's or any other, and then use that to determine what I want to invest in, whether it's one of their recommendations or not. I would just never blindly go in and just buy something just because I thought it was a good deal or I got a good tip from a newsletter, regardless of how much respect I had for that newsletter. So that's how I'm planning on leveraging it. Okay, that was urgent. All right, Jet Set Orsvet, what's up, man? What's up? I'm not going to say this person's name, but very, very good friend of mine. GG, you going to watch the opening of F1 in Oz next weekend? No, you know my answer to that. Why are you making me answer that on the live stream. You know what I'm going to say to that. Looks like Max Lewis Crown. Yeah. My buddy and I are huge Formula One fans. He's still a Formula One friend. Once they stopped doing the grid girls, honestly, it was just it became too politically correct for me. And you can either say that's a good idea or a bad idea. I'm not here to judge anyone's opinion, but just for me personally, once a sport gets to that level where they're that politically correct, it's like, okay, I'm done with you. I just can't take it seriously anymore. Kevin, thank you for the super chat. George Tipjar, thank you for all your work. Thank you, Kevin. I appreciate it. XRP, really enjoy watching your videos. Very informative and enlightening. Thanks so much. I appreciate that, XRP Hodler. And Kevin, I want to say again, for all of you on the live stream that go to the channel, I really sincerely appreciate not only the super chats, but even more so you guys taking the time out of your schedule to watch the videos, comment, give me a thumbs up for, what is Graham always say? Or for the YouTube algorithm. That's what he always says. That's right. I don't know if it helps the algorithm or not, but you guys are very, very engaged in the comment section. And it's just time out of your schedule. And I know how valuable that time is. I want to make sure that you guys understand that. We never, myself, Sebastian, any of the editors, we don't take that for granted. Sebastian told me to check the time. Okay, we got about 10 minutes left or so. Okay. Charvis, thank you for the super chat. Hey, George, I recently got into shoe shining. Okay. Thanks to my brother. But my friends are making fun of me. Do you think shoe shining is a viable source of income? I'm investing savings, but conflicted. What? Listen, Charvis, if it's making you money and you're able to save money and invest that, I don't care. What? I would tell your friends to jump off the nearest cliff. I wouldn't. Listen, I'm trying not to use profanity, guys. You can see I'm struggling with it here. No, what are your friends talking about? You're out there making an honest buck. You're working your tail off. You're doing the right thing. You're saving money for your future. Come on, I don't like that attitude that your friends have at all. Let me tell you a quick story here, and I'm sure I'm behind on the super chats, but it's really important. I have worked some of the crappiest jobs you guys could ever imagine. Most people only see you like right now. Obviously, you guys have only known me for 5 or 6 months, and you just see this guy that's retired, real estate investor, knows a lot about econ, has this YouTube channel, has made money in the past, retired early, millionaire, 34, blah, 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 right? But you don't see all the 15, the 20 years prior to that, where I got my first job at 15, where I was delivering pizzas and washing dishes. And then throughout high school, and throughout high school, I was working construction. I was a laborer on a construction crew in Portland, Oregon, in 35-degree weather when it was pouring rain out in the mud. And yeah, sure, my rich friends were making fun of me. I didn't care. I could care less. I was out there doing what it takes to make things happen. Even when I got out of college, I started a couple businesses. They were terrible. I lost money in every single one of them. And I took a job. This was back in, it wasn't like in the 1950s. This was like in the late 90s. Like 98, 99 or so. I took this job where I was only making like $400 a week. It was something, I remember it was so low that I couldn't pay my bills at all. And all my family members, they weren't making fun of me, but they're literally angry with me for taking that job. But I took the job because I saw it as a learning opportunity, because I looked at the business. I said, you know what? If I can learn how to do this, I think I can leverage that to make a lot more money in the future. It's exactly what I did. exactly what I did. And from that, I parlayed that into a consulting business and all these things. But my point is, even if you're out there shining shoes, you're learning a skill, you're saving money. And who knows, with the skill set that you learn from that, you could turn that into your own business. And the next thing you know, you could franchise it. You could do deals with airports. You could do, who knows, the possibilities that can stem from something that at the time it seems so humble and it seems like nothing. But if you've got the right mindset, you can take that knowledge and you can expand that, and you can make a lot of money. And just the bottom line, I don't want to get too far off on a tangent, get too far behind here, but it really irks me. It drives me crazy when I hear their stories like this, where you're doing the right thing and your buddies are making fun of you. Just completely ignore them. Maybe try to find some new buddies. Manuel, thank you for the super chat. What are your thoughts about Treasury General account removing liquidity from the repo market? Yeah, I haven't checked the TGA account lately. I know it was over 400 billion. And that if Dr. Barton Wang is right, and there's two opposing views here from guys I really respect. First, it's Real Vision with Raoul Paul. When he did that interview with Dr. Barton Wang, I'm sure a lot of you watched that. He's saying that the TGA is kind of the way that the Treasury now has the Fed in a compromising position, let's just say. And that they can get them to do pretty much whatever they want, because they can suck reserves out of the system or they can pump reserves back in, meaning the Treasury could basically do their own round of quantitative easing. Or if they wanted the Fed to print more money, they could suck those reserves out of the system, making those dollar funding markets tight, forcing the Fed to go in and take action. And I won't go into the mechanism. I've done a couple of videos on the mechanism of how that works. But so Dr. Barton Wang's opinion is that they're going to leverage this, and they could very well leverage it coming into the election, or because of the cerveza sickness, if they wanted to prop up markets or try to prop up markets, they could do that by injecting more of that liquidity that they've been saving up, all that dry powder that they have in this Treasury General account. I brought that up with Jeff Snyder. Jeff Snyder he saw how that could work logistically, but his point is he didn't think that was going to happen, because he just thought that the people at Treasury just weren't smart enough to connect those dots to even know the power that they had. So I think, will they use it? I don't know. I mean, I don't know anyone at the Treasury. I don't know anyone in the administration to know if they're smart enough to know how much leverage over the Fed that they actually have. But it is definitely a possibility, and it's something that we should all be watching. So thank you for bringing that up. And if you guys don't know what I'm talking about, make sure that you look at the Fred chart for the Treasury General account. Look at what it's been doing since 2016, what it did with Obama and what it did prior to the GFC. You'll know immediately what I'm talking about. Dimitri, thank you. Lost your question, Dimitri. Thank you for the super chat. Hi, George. Can you elaborate on yesterday's video? How can I see the repo fails? Let's see. I'm a physician. Cerveza sickness is BS. If anything, hospitals are less busy now. Okay. I appreciate your opinion. I don't, if you're a doctor, you've got first-hand experience with this. You're in the trenches. Maybe they're less busy now. I don't see that being the case in a month or two, but I hope you're right. I 100% hope you're right. As far as the video, how can I explain this? The repo market is this big. 2.2 trillion daily, maybe even more when you consider the reverse repos. In fact, a lot more when you consider the reverse repos. What we are seeing when we go to the New York Fed's website and we see the oversubscribed, remember how I've been talking about that in a lot of my videos? we're only seeing 50 billion, 100 billion of those 200 or 2.2 trillion dollars worth of transactions that happened. So just a small fraction of that. Yes, there are charts that I've seen where you can see the repo fails. What is a repo fail? That's when JP Morgan goes to hedge fund, or hedge fund ABC goes to JP Morgan and says, listen, we need liquidity. We've got these treasuries. Let's do a repo at 1.1% or 1.12%. And they say, fine, let's do it. And then when they go to execute the transaction, and I don't know the time frame, this maybe an hour later, half hour later, I don't know. But one of the parties backs out. And once that transaction is submitted, I'm guessing in some sort of computer system, then one of the parties says, nope, I'm done. I'm not doing it. That is a repo fail. And they track that. So you can see the repo fails going back to 2008. I think you can even see them going back to the 90s. And you can really look at that, how that affected gold in that 2008 period. So when the repo fails spiked, and back in 2008, when Lehman went bust, the repo fails went up to 5 trillion. 5 trillion. Now, I'm guessing that's a weekly chart. I'm hoping that's a weekly chart, but it just goes off the charts. So that's what I would be looking for if I was looking for a definitive bottom for any of these assets that people may be using as liquidity: gold, silver, the miners, Bitcoin. And what I'm using as a proxy for that, just because of the data for those repo fails, at least the data that I've been able to find, is like a month old. So you can't really see the last couple of weeks, which obviously is hugely important. If you guys know of where I can find that chart of that data, please let Sebastian know. But I'm using the data from the New York Fed as a proxy because you can get that in real time. 8:30 in the morning, and it's, from what I've seen, it's automatically updated between 8:30 and 9. So again, just to be clear, I'm using the New York Fed's data as a proxy for the entire repo market and the repo fails. RU42112, thank you for the super chat. Do you see MoneyGram pricing rising with Ripple investing in MoneyGram to create more liquidity for XRP? Boy. I didn't know about this. I'm trying to think through. I mean, any type of deal, I'm assuming they're going to use the XRP platform to make the transactions smoother. I don't see how there's a lot of downside there from MoneyGram. I struggle to give you an answer on that just because I don't know it well enough. So I appreciate the super chat. I hate to punt the question, but I think the best answer I can give is I don't know if that'll raise the price of MoneyGram, but I don't see how on earth long term that would be detrimental to them. I think there could only be upside with that relationship. Jacob, thank you for the super chat. Hey, George, have you read Zoltan's new 17-page report on what's going to happen to the financial system in the next crisis? Would make for an amazing video. Yeah, I saw that the other day. I didn't read the whole 17 pages, but generally what he does is he kind of summarizes it in a few paragraphs on the first page. So I read his summary, and I answered someone on Twitter that asked me this question. I said I'd most likely do a video on it, but it's pretty much the same as his last letter that he came out, or the last report he came out December 9th. I told the person on Twitter it looked like the same hamburger and just like a different wrapper. like one time he had it wrapped up as a Whopper, and this time he had it wrapped up as like a Big Mac. But you kind of read it, and he's saying the same stuff, that they're going to have a liquidity issue. The Fed's going to have to do QE. Pretty much the bottom line. But I think it would be a really neat video, Jacob. So depending on what happens with the news flow, as you guys can tell, in the last couple of weeks, I've tried to, instead of just doing like evergreen videos, like how this works, I'm trying to do more topical videos, because I think it's really important that we all stay up to speed on not only the news flow with everything that's happening, but also why the news flow is happening. And I think that's hopefully the niche that we're able to fill on our channel, is that it's not only telling you guys what is happening, but telling you why it's happening. So that's why I'm trying to be a little more, follow the news flow a little bit more. Wally, thank you for the super chat. Futures down 1,100 now. Looks like a crash. So let's, assuming that plays out tomorrow, guys, let's really watch the price of gold and the miners. And if gold goes down, you know that it could be that liquidity issue we've been talking about. If it still goes up, then you know that we've got those cross currents of fear, liquidity, and collateral, and fear has just completely taken over the other two. And then I'd become more bullish on gold itself in the short term. Jonathan, thank you for the super chat. Grabbing tickets to GNR at Fenway. You in? You got an extra mask for me? I love GNR. In fact, I've got tickets. I bought Sebastian and all my team that wanted to go. I bought everyone tickets to GNR in Bogota, April 8th, if I'm not mistaken. I'm flying up all my people, the people that work for me that want to go. I'm flying them all up to Bogota, putting everyone up, and I bought everyone the tickets to the Guns N' Roses. So I really hope that the cerveza sickness doesn't come here to Colombia, because I'd hate to miss out on GNR. But congratulations, that's really awesome. Just hopefully that the concert still happens as a result of everything else that's going on. Manuel, thank you for the super chat. Thank you for the thumbs up super sticker. Thomas, Chinese stock market. Oh, we're just over now. Okay, guys, so no more super chats. I'm going to finish up here, and then I've got to get some dinner and get ready for tomorrow's video. Thomas, let's see. Oh, Chinese stock market is higher than before cerveza. That's because of all the funny money that they injected into it. And plus, I think they banned short selling. Could the Fed pump up the U.S. markets the same way? They could. It's not my base case. I think that our markets were even more inflated, so we have more of a bubble to deflate, but it's not zero. I would say that it's 20-30% compared to maybe even higher. Maybe it's a 40-60 type probability, but it's for sure possible. That's why I'd hate to be short right now. I'd much rather have a watch list of longs than just go short. STP Trader, thank you for the super chat. ES overnight limit down is 28.19. The NQ overnight limit down is 8,000. Hi, George. Great show. Thank you very much. I appreciate the info, and we're just going to have to see how it plays out tomorrow. Definitely, we want to pay attention. It's going to be an interesting day tomorrow. That is for sure. Man, with the gold, or excuse me, with the oil and the futures. Daniel, after your interview with Marin Katusa, what is your take on the uranium play? I like uranium because it's dirt cheap. I don't know if we've seen a catalyst yet that would be a trigger for it going back up. And I haven't done a lot of videos on Jim Rogers, and he's one of my favorites, if not my favorite. And what made him so good and what makes him so good is he finds things that are dirt cheap, but he's really good at finding a catalyst as to what is going to trigger the move back up. So in the short term, I'm probably more bearish. I'm probably more bullish on the miners, the gold miners and the silver miners. But I think uranium's really interesting, very cheap, and longer term, I'm definitely bullish. Okay, guys, I think that is it. I appreciate everyone being on the live chat. I want to encourage everyone to go over to my buddy Jason with Wall Street for Main Street. He texted me today and said that he is going to be talking more specifically about the oil market, the crash in oil that we've seen and what it's most likely going to do tomorrow. And he knows a lot more about the individual companies and the fundamentals of each company. So if you guys are interested in that, I'd strongly suggest going over to his live stream as soon as we get done here. And when I'm eating dinner, I'm going to be in that live stream as well, going back and forth. I think he probably started it about 10 minutes ago. So guys, shoot over to there as soon as we get done. And reminders, the podcast, go to the podcast, check it out, guys. Rebel Capitalist Show. Give it a thumbs up, subscribe, and if you would do me a huge favor, leave us a not a recommendation, but do the feedback or whatever it's called. That really helps out that algorithm. And lastly, remember the affiliate guys that I'm doing with Marin. We talked about that several times, but if you are interested, I think you're going to get a great product. At least I've really been enjoying it. And you're never going to get it at a better price. So just go to katusaresearch.com/George Gammon. Or we also have an affiliate link on georgegammon.com under the resources tab. That said, I will see you on tomorrow's video. And right now, I'm going to see you over on Jason's live stream. Bye, guys. Have a good one.